Joining me here, post 9, to explain is New York Life Investments economist and portfolio strategist Lauren Goodwin. Welcome back.
Thanks for having me.
All right, now, I already had one big debate with a longtime bear in this market. You've been cautious for a while, too, and you're not ready to change your tune either. Why?
Importantly, I'm very cautious on the economy this year. I'm less cautious, at least tactically, on the market. I expect that this market is going to continue to trudge further along until we hit one of a couple things that could break it, most of it having to do with economic data breaking decisively to the downside.
Okay. Why would I believe that it's going to do that? You say a soft landing is looking even less likely. How so?
I expect that a soft landing in this cycle and in others is just a moment in time that we as investors should always leverage on the path to something else. And because the Fed has been restrictive for long enough, and I do expect that that restriction is taking its toll on the economy, we're seeing it in the data. That's what I saw last week. I saw an inflationary environment that's going to make it hard to cut rates as quickly as the market was hoping. And I see a consumer and a retail environment that's early stages, but just starting to see some softness. That's an environment I expect to continue to slow.
See, there were a lot of calls, I said at the very top of the show, kind of bulls and bears both seemingly emboldened with each of their cases. And the bears would say, look, see, CPI, PPI, inflation is going to be a lot stickier than you bulls think it's going to be. But then you had people come out and suggest, either current or former Fed officials say, you're overreading and overreacting to 1 month's number, in which was an anomaly anyway, because January is funky.
And both of those views are right, by the way. Mixed economic data is a classic late cycle environment. And I think what's happening in the market is that investors are getting whipsawed by their own expectations. This is an environment, if we take a year's approach, that where inflation has been moving lower, economic growth has been moving lower, especially lately. And when I look at the way that the economic cycle tends to evolve, that's an environment where I do expect the longer the rates are where they are, that the credit environment for households and businesses continues to be challenging. Now, we're not there yet. There's nothing breaking. That's why I expect investors should stay fully invested. But we have to start being a little more attuned to how we're getting whipsawed and try to see the through line.
What if you say, I know that the Fed made mistakes in how late they were to the hiking game, and now they don't want to snatch defeat from the jaws of victory, so they're going to be more cognizant of the risks that you cite. They don't want a credit event to happen where they have to be reactive. They're going to be proactive in cutting rates. It may be a little later than the calendar schedule of what we thought, but they're still going to do it because they know and they're confident in the fact that inflation is going back to target. That makes sense?
I think it makes sense. I also think it's the right call.
Well, then why be negative?
If anything, I think the Fed's still going to be too late. This is an environment where sticky inflation, has made it really hard for the Fed to be as proactive as would navigate a soft landing without juicing inflation further. And that's why, at the end of the day, soft landings are really just a Goldilocks moment in time on the way to something else. It is very, very difficult to sustain growth and also avoid wages continuing to stay sticky, inflation continuing to stay sticky for very long.
Okay. So the actionable investment advice based on your idea of where this market goes is what?
I expect that the Fed is still liable to start cutting. My best guess is June. That's an environment where I think it makes sense to be moving into short duration credit out of cash. You and I have talked about that quite a bit.
Yep.
It's also an environment where quality continues to be important. And so while valuations in tech are high, I think we should look at some of the long-term themes like infrastructure, like AI, and start to broaden that exposure in order to diversify a bit from the themes we know are working.
You say broaden the exposure and like to more growth AI-related plays? What do you mean?
Yeah, looking to the small and mid-cap growth areas where we see profitability and more the application layer of artificial intelligence. Also digital infrastructure, some of the areas that we think might be resilient if we do expect equity markets to experience volatility as growth slows.
See, this is what I find like troubling to sort of make ends meet. It's a cautious view overall on the market, even in some respects, but acknowledging that, well, the growth trade can work. It still works because of the secular trends of AI. If those stocks continue to go up, I find it hard to believe that the market's going to have a problem.
Profitability is really what it's about, as opposed to growth or tech necessarily. That's just where we happen to see.
They have that, though, right?
Profitability, exactly. What that broader idea is about is acknowledging that 6 companies is where we are seeing all of the growth and profitability, and that's what's been working.
Well, not
but
all.
It's not a particularly diversified play, right? Like you could see, and there's been a lot of talk about it today already, if you see one miss in expectations, that's what burst the bubble in the aughts. That's what burst it was one company suggesting that they might see sales growth of more like 50% instead of 60% that popped that bubble. And that's the type of risk I think investors need to be mindful of when they're looking for profitability, to look further.